This is Chapter 14, Taxation. Real property taxes or real estate taxes are billed twice a year in California. The tax year runs from July 1st to July 30th, and payments are due as follows. November 1st, property taxes are due. December 10th, they're delinquent. February 1st, they're due again. So November and February, you have taxes due, and April 10th, taxes are late. If you want to remember this, use this acronym, no darn fooling around. So due in November, late in December, due in February, late in April. Any person acquiring an interest in property subject to local taxation must notify the county recorder or assessor's office within 45 days. Now, at close of escrow, when the grantee gets recorded, the county recorder does get notified, so you don't have to worry about that on a purchase. On a purchase also, this is a reassessment event. We'll talk about that a little bit later. And that per the contract, you've set a value on the new property. So it's a reassessment event of the value of the property. So the property taxes will be based on that value that the contract determined. Proposition 13 in California puts a brakes on property taxes changing, meaning once you closed, you establish the fair market value of your purchase price. So the next year, the county can't just reassess at a new value and base the taxes upon that. Under Proposition 13, property taxes set at 1% of the value at the time of purchase. Now, the counties can add a little bit also for supplemental taxes, for fire, for education, and things that are specific to their area. What this does is eliminate some hardship on people also, in that the property taxes cannot be just changed and raised at the whim of the county. For example, if somebody bought their house, say 30 years ago, and they bought it at $200,000, their property taxes would be around $208 a month. Now it's 30 years later, and they're getting close to retirement, and that family would be on a fixed income. It wouldn't be fair to have their property reassessed at the current value. They bought their home at $200,000, now the house is worth $700,000, and new property taxes would basically be a huge burden on somebody with a fixed income, say in retirement. So here's an example how Proposition 13 can work. So Proposition 13 sets the base taxes at 1%. Now, in certain areas that could rise, so we're going to use an estimate of 1.25. But each time you're going out and investigating a property, make sure and do some research on what the tax base is in that area, because you don't want to quote inaccurately. There may be Melrose assessments and other school board assessments that need to be taken into consideration for the property taxes. But in this case, property taxes are 1.25%. Mr. Smith purchased his home for $600,000, and we assume property taxes at 1.25%. So what that means is the taxes per year would be $7,500, or twice a year, since you pay in November and February $37.50. So you pay every 6 months. So what Proposition 13 does, it limits the increase on that base price. So for example, in this scenario, that's $7,500 a year. Proposition limits the increase to 2% over that price. So the next year, instead of a full assessment, the worst case for the payment would be $700, $750 plus 2%. So that would be an additional $150 on the taxes. So $76.50. But it's not a complete reassessment event. Here's another example of how to work out the payment. You can do it on the base taxes, or you can increase the estimated value of the property. So they started at $600,000, and it's going to increase by 2%. So if 2% of $600,000 is $12,000, so if you take that base price as $612,000, you basically get the same payment increase, and that would be $76.50 per year for taxes. Here's another example of somebody purchasing a lot and then building a home. So they purchase the lot for $50,000 and they have the cost of materials at $100,000. So the cost of the house to build was $150,000. But because of the Mr. Wilson's ability and his ability and labor of that home, the fair market value could be set at 250, and the local county assessor could legally assess the home at 250. However, what they'll normally do is take the cost of the acquisition, the 50,000 plus the 100,000 at 150. There's a good chance they would estimate it at $150,000. But then again, too, it's up to the county tax assessor at that time. This is something you really need to warn your customers about. If you have a buyer that's purchasing a home, when they go through closing, they'll estimate the closing and the prepaids, meaning the taxes, insurance, and interest, at the taxes the seller is paying at the time of close. So even though your loan officer is estimated based on the new value, based on the purchase price of what the home taxes will be, there may be an adjustment in a supplemental tax bill in that you closed on the property and whatever the selling is paying taxes on, but that's all the county tax assessor knows to, to send out a bill at that time to collect the taxes, but now they're increasing. So what you may have 6 months later is the county tax assessor coming up to speed with a new value and then sending out a supplemental tax bill that was due for the time the seller sold the property to you over those 6 months to bring the property taxes up to current value of the property and collect those taxes due, the difference between the seller's value and the new value over those 6 months. So sometimes the buyers are a little miffed when they find out that all of a sudden they have a supplemental tax bill from the county tax assessor. So just warn them once they close in about 6 months, once their new value gets recorded within the county tax assessor's system, that they may have a supplemental bill to make up that difference. This is Proposition 58, and basically it's an inter-family transfer. So if someone has a principal residence in which they're a homeowner, there's an exemption that can be transferred from parent to child with no charge or change in the value of the real property up to the first $1 million. So what that means is the parents can transfer that ownership to a child, and it's not a reassessment event up to the new values of properties. So mom and dad bought the home for $50,000 30 years ago, and today that property is worth $500,000. The property taxes for the kids are still based on the $50,000 taxes. Prop 60 is a similar benefit to a homeowner. Prop 60 basically states that you can transfer your tax base to a new property. So you have to be 50 years, 55 years or older to transfer your tax base to a new property. So you're selling your home currently and you're buying a new home. Normally people will step down or lesser value. In this case, normally they're looking for equal or lesser value in the new home you're transferring to. So both properties must be in the same county. The claimant must be 55 years old, 55 years or older, and then they can transfer that tax base. And normally that resident is eligible for a homeowner's exemption at the time of the sale, meaning you get exempted from the value of $7,000 from the full cash value. So your taxes are based on the full cash value less the $7,000 exemption. The new home must be purchased within a 2-year period before the sale of the old home or within a 2-year period after the sale of the home. And regarding Proposition 60, if the new home was bought before or on the same day of the sale of the old home, the purchase price of the new home must be equal to or less than the sales price of the old home. Proposition 90 is an extension of Proposition 60. However, what Proposition 90 allows you to do is to sell your home in one county and purchase another home in a different county in California. However, what you have to do is make sure that the county that you're moving to recognizes Prop 90 so you can transfer your tax base. If it's not recognized in the new county, they may reject your request to use Prop 90 and transfer your tax base. So here's a list of counties that will allow Prop 90, meaning you can transfer your tax base from, say, San Diego County to Alameda, Los Angeles, Orange, Santa Clara, San Diego, Riverside, San Bernardino, San Mateo, El Dorado, and Ventura. As a sales agent, you need to be aware of special assessments in the area where your subject property is located. Special assessments are levied for local improvements such as streets, sewers, schools, irrigation, drainage, flood control, and so on. So you may have some special assessment taxes in that area. So in addition to your 1% for your Proposition 13 tax base, you may have special assessments that may bump that up to 1.25, 1.5, 2%. So you need to be aware of that when you're selling homes in areas that have mellow roofs and special assessments. A homeowner's exemption is a benefit that decreases the taxable full market value of the property. You need to apply for this, but basically in our area, in California, you get a $7,000 exemption. So basically that's taken off the full market value of your property, and then the property taxes are based on that figure. So you need to apply for that. You only need to apply once, and once it's recorded, it remains in effect until it's terminated. A veteran has a special assessment, but is entitled to a $4,000 exemption. However, you can't double dip. You can't take 7,000 plus 4,000, but you'll take the higher. So you'll take $7,000 as your veteran's exemption. Disabled veterans are entitled to a higher exemption, and the exemption can be transferred to a surviving spouse. There's also a senior citizens property tax postponement. And what it means is there's a benefit where you can postpone your property taxes until you no longer occupy the property. And some of those requirements are, you have to have an age restriction, meaning you're 62 years of age or older, and there are income limitations. Presently, that's $35,500 in combined income per the household, and have a 40% 40% equity in your home. And then you can postpone your property tax payments until the property is sold or you no longer occupy the house. There are some lower tax assessments available for agricultural areas. For example, the Williamson Act allows local governments to tax land and agriculture using a different method of value, and gives a benefit for people who keep their properties in an agricultural state, meaning they're trying to avoid massive building in areas and slow it down. So the Williamson Act is one of those acts that give an incentive for owners to keep their agricultural property intact and not sell it to, say, builders or mass developers. There's a couple of acts like this within San Diego County. The Williamson Act is just one of them. There's a documentary transfer tax that we have in our county. So I know it says may adopt a documentary transfer tax, but we do have one in San Diego County, and it's 55 cents for each 500 or fraction thereof of the equity transferred. Normally the seller pays for this. It's normally not a buyer's cost. The way to easily calculate it is just take 0.11% of the sales price. So 0.11% of the $500,000 is $550. That'll be collected in escrow as a debit on the seller side of the closing statement. Income taxes, of course, play an important role in the decision to buy or sell or trade a piece of property. But as a real estate agent, you should not advise people on income tax matters. Refer them to their financial advisors, their accountant, so they can make a make an educated decision on the property they may be thinking about selling or buying. Depreciation is a method of accounting for the wear and tear that results from the use of a capital good, and we can use that in real estate for investment properties. So this is for investment properties only, and it's on the structure itself. The land is never depreciated. So how do you determine the value of the structure? Well, the first method is the assessed value method, where you can use the same ratio and calculations that the tax assessor uses for your tax basis to determine the value of the improvements for depreciation. You can also get an appraisal and have the appraiser appraise the property as to the value of the land and also the improvements. You can also use the contract method between the buyer and seller. They agree on the value of the property and also an estimated value of the improvements and also the value of the land. So then you have the value of the structure that you can depreciate. So to compute depreciation, normally the improvements are depreciated in a straight line method. For a residential property, you'll use 27.5 years for the residential, 39 years for non-residential or commercial property. Here's a situation that shows how depreciation can help shelter passive income from a rental property. In this example, you have income on the property of $40,000. You have other operating expenses, which could be homeowners association dues, landscaping, water, trash, whatever. So it's 20 grand. And then you have your depreciation figure of 10,000. So 40,000 minus the 30,000 is $10,000. That becomes taxable income. So you've sheltered passive income from a rental property. So using depreciation to shelter passive income on a rental property can be used without limits. However, if you want to use some of those sheltering benefits against active income, it has some restrictions. Meaning, can I take these write-offs from my passive and bring those toward my active income and decrease my adjusted gross income? Well, what it says is for taxpayers with adjusted gross income of $100,000 or less, the taxpayer is allowed to shelter up to $25,000 of active income. Meaning, if I have a loss on my rental property, I can carry that forward to my active income and decrease my adjusted gross income. For taxpayers having an adjusted gross income between $150,000 to $150,000, the taxpayer can shelter $1 for every $2 of income over $100,000. So what happens when I have a capital gain on a property? Say, for example, I bought a property for $700,000 and I sold it for $800,000. Do I have tax liability for the $100,000 gain? Well, yes, you do. In 2003, the Tax Relief Act reduced the long-term capital gains to 15%. As of 2013, higher income taxpayers, $400,000 for single and $450,000 for married, will have a rate of $20% tax rate for capital gain. In addition to, if taxpayers have adjusted gross income of $200,000 for single and $250,000 for married, you may have a tax liability for a Medicare surtax of 3.8%. So what's a capital gain? A capital gain basically is a property held for more than 12 months. If the property is held for more than 12 months, then it would be a capital gain. If it's held for less than 12 months, then it's taxable as regular income. For lower income taxpayers, lower tax rates of between 12 to 15% federal tax brackets, there's no capital gain taxes that are incurred on a property. The taxable gain is the difference between the cost basis of a property and the net sales of a property. Types of basis, meaning where do I start to determine my capital gain? What's my tax basis? The starting point is on real properties called the original basis. And the original basis is the purchase price plus buying costs. So if you purchase a property for $600,000, but you had buying costs of $20,000, then your original basis is 620. So you bought the property for 600, sold it for 700. You don't pay the difference of $100,000 capital gains. You pay from the original basis, which is purchase price 600 plus buying costs 620. So that's of 20,000. So that's 620 minus the 7 is an $80,000 gain, not a $100,000 gain. Now the basis will change over time based on your depreciation taken. The depreciable basis is the amount of the original basis that is allowed to be depreciated by law. The adjusted basis is the original cost plus improvements less all depreciation taken. So the adjusted basis is the purchase price plus the buying expenses plus any capital improvements and then less depreciation. And we'll see an example here shortly. So in a sales scenario, to purchase the gain computed, it's the purchase price plus buying expenses plus capital improvements minus accumulated depreciation minus the adjusted cost basis. Then take the sales price of the property you're selling, less the sales costs, and less the adjusted cost basis we just calculated, and that'll give the total taxable gain. And the gain, once again, is the sales price, what you're selling your property for, less any selling expenses, and less the adjusted basis on your property. So here's a scenario. You purchased the property for $80,000. You had $800 associated costs, plus you added $3,000 capital improvements. That gives you $83,000. Less the accumulated depreciation, your adjusted cost basis is $71,300. Okay, now you sell the house for $100,000, less the current sales costs on that sale, and then less your adjusted cost basis, you have a total gain of $24,700. 1031 exchanges. Basically, it's a tax-deferred exchange. So you're deferring the exchange in the purchase of another property. And this is only good for investment properties, not for personal properties or owner-occupied properties. The 1031 exchange has some things and rules that you need to be aware of. Number one, it's like kind property for like property. So it's investment for investment. It does not have to be single family for single family. It could be single family investment for commercial property, single family for units. You can do that. It has to be for investment or business purposes only. And it has to be for equal or greater value. Because if you're buying something for less value, you're not going to transfer all of your equity into the new property. If you do a 1031 exchange for a property with a lesser value, you're going to get cash out. That's called boot, and that's taxable. It has to be for the same taxpayer. Here's some timelines too. Once you do your sale, you have 45 days to identify a new property, and then 180 days to close the purchase. So boot basically creates a taxable event. You're buying an unlike property, a property that's not equal to the one that you currently have. You're selling yours for 500, buying something for 400. You've got some inequities there where you're going to pull some money out, and that will be taxable, and that's called boot. Once again, you created a taxable event where all your interest is not going into the other property. So the unequal properties create that taxable circumstance where you're going to get taxed on the amount you received, and that's called boot. Here's some definitions. The first one is buy up rule, meaning you should always buy up. You don't want to have a gap in there where you haven't moved all of your equity dollars into the new property. If there's a gap there and you're buying a property of less value, you'll have a taxable event. The entity rule. One thing to remember is the entity doing the exchange has to remain the same. So if you're entitled as an individual, LLC, partnership, or corporation, that can't change through the 1031 exchange. And the investment rule. The property must be held for investment or business purposes and not personal property, primary residence property. This has to be a like kind. So the real property must be exchanged for other real property. And there's a no choice rule. And I've seen this happen in one personal circumstance too. I didn't do it, but I was doing a loan for the buyer. Uh, if the transfer qualifies for an exchange, it always must be treated as a tax deferred exchange. In my situation, the person was doing a 1031 exchange, buying a new property, and he said, yes, I want to live in that property. Well, it's a tax deferred exchange. That has to be an investment property. And the loan he took out with me was for personal residence, so he couldn't do it. The 1031 exchange told us that's not a like for a like. It has to be investment for investment. A loss in exchange can't be recognized. It must be deferred along with other gains. Money control. At no time can the exchanger have the control of the buyer's money. And what happens too is when the titles and money start to exchange, what the exchanger will use is an accommodator, normally an escrow company, and they'll handle the whole 1031 exchange so the money isn't commingled to other accounts, and it just stays right there and is ready for the purchase of that uplake property. Here's some terminology. A delayed exchange is for an exchanger who has not yet determined a property which they want to buy on the uplake side. So what happens is this person has already sold his property and hasn't determined what he's going to buy yet. Well, what he should do right now is go to his accommodator, deposit the money for his 1031 exchange, and then within the next 45 days, he or she must identify a property that they want to purchase. After that, the accommodator and the exchanger have 180 days to close the transaction. A reverse exchange is just the opposite. You've already identified the property. I want to buy this property and do a 1031 exchange. Okay, you open your escrow with your escrow officer to do the 1031 exchange. They become your accommodator, and then you go ahead and sell the downlay property to complete the 1031 exchange to purchase the property you've identified for your 1031 exchange. Installment sales is a way to defer taxable events. If you sell a piece of property and you have realized $300,000, that's a taxable event and may be subject to capital gains. One way to avoid that is through the installment sales treatment. So what you may do, you're selling a piece of property. You may tell the buyer, hey, you know what, give me $100,000 and I'll carry a note for $300,000. Okay? With the installment sales treatment, you will have tax consequences on the down payment. But on the other monies coming in, as you get paid installments, then you're taxed as those installment payments are realized. All right. CalVet uses that. They use an installment sales treatment. So if a veteran wants to purchase a piece of property, they go to CalVet, identify the property. CalVet actually purchases the property, and then the veteran starts making money paying installments to CalVet. Okay. The veteran is actually the equitable owner, but CalVet is actually the legal owner of the property until all installments are paid, that debt's paid off, and then the legal ownership goes to the veteran. So with the installment sale, it's a tax deferral, and payments are taxed as they're realized. You may experience some sale leaseback situations, and it may not be with a business property. I've seen a number of situations where there are time frame differences in contracts where buyer and seller agree to a sale leaseback, maybe 30, 45 days until some other event happens, and then the buyers can actually move into the property. So you can see a sale leaseback there. But in businesses, that can happen also, where the seller actually sells the property to the buyer, who becomes the landlord. So it's a sale leaseback. I'm selling you the property. I still want to lease my business that is on that property. Couple advantages. A lot of times the business can free up capital, pay off some bills with the proceeds coming out. They can also remove trust deeds from their balance sheet. In addition to now they're paying rent and they can totally deduct the business rent that they paid. A personal residence is normally called primary residence, owner occupied residence, but it's where a person or husband and wife live together. So the personal residence is where the owner spends most of their time. Other properties owned are termed second homes or investment property. Second homes are normally out of the area where somebody goes to vacation to. Second homes get no preferential tax treatment as to capital gains. Normally, when a lender sees a second home, the interest rate pricing is about the same. But the buyer or purchaser of a second home has to qualify for both payment, primary residence and also the second home residence. Owning a property, residential property, has some benefits in that you can write off your property taxes and your interest. And both of those you would write off on your Schedule A, and that'll reduce your adjusted tax basis, your adjusted income. So normally now, as of 2018, you can write off up to $10,000 of your property taxes. With interest on homes valued up to $1 million, you can write off your interest. So say, for example, you had property taxes of $8,000 and you paid interest over the year of $10,000, you can write off $18,000. So if I have a gross income from the year of $80,000, I can write off 10 plus the 8,000, that's 18,000. My adjusted gross income is now 62,000 that I pay taxes on. If you have a home equity loan or a HELOC, if the loan amount is $100,000 or less, you can write off the interest on that. Any additional secondary residences can't be considered a personal residence, and these are not deductible. Investors have some benefits of tax-deferred programs like a 1031 exchange, but what about people that are primary residences in their residential property? Well, if you have a personal residence and you sell it, a single person can exclude $250,000 from being recognized as the capital gain. So if you sold a piece of property and you gained $200,000, that's below $250,000, you don't have any capital gain exposure. A married couple can exclude up to $500,000. In fact, I've known people that have done this. I had a friend who owned a piece of property, had a rental property. They wanted to sell the rental property. They moved into the rental property for 2 years. The rule is you have to live in that property for 2 out of the last 5 years. They waited 2 years, sold the property, had the $500,000 exclusion, so they paid no capital gains when they sold their rental property. And once again, the rule is you have to live in that property 2 out of the last 5 years. Now, this is just not a one-time event. You could use it more than once. So you could leave your home, move into the one property, stay there 2 years, sell it, get your exclusion, and then move on to the next and do the same thing. There can be some relief for forced sales under this situation if a taxpayer fails to meet the 2-year rule. So they would have a taxable event if they sold within 2 years. But if they've had some hardships like unstable employment, their health has failed, or certain unforeseen circumstances, they can get a break and get a partial exclusion. The Foreign Investment Real Property Tax Act, commonly called FIRPTA, requires that a buyer withhold 15% of the sales price for estimated taxes when the seller is a foreign person. What the government's trying to avoid is a foreign national living in the United States selling a piece of property and taking 100% of their capital gain back to their country of origin. And I should say too, this is done through escrow also. Escrow will help collect the FIRPTA and the CalFIRPTA estimated taxes. The deposit must be made within 10 days after the close of escrow. And for personal residences, the property has to have a sales price of $300,000 or more. Also, state of California joined in with this too and followed the federal version of this. So you have Cal FERPTA as well. And what happens is the withholding for California is 3 1/3%. It does exclude sales of the seller's personal residence. This is for the Cal FERPTA only, and the sales price is under 100,000. Since we're on taxes, I thought I'd talk about taxes as it relates to real estate agents too. Now, you are an independent contractor, and what that means is your broker is not going to give you a W-2. He won't pay federal and state income taxes for you, and also will not match any Social Security. So there's a couple things you need to prepare for and be aware of and do to be successful in real estate. First of all, you're going to get a gross check coming out for your commission. Make sure and figure out a portion of that and do quarterly deposits to the state of California and also to the feds. And you can do that online. It's a very easy process to do. So make sure you do quarterly statements. Also for retirement, as I just stated, the broker does not match any Social Security funds or retirement funds. You should consider doing that first. Pay yourself first and set up a retirement account, either a SEP, Simplified Employees Pension, or minimum do an IRA. So you want to have some money left over when it comes to retirement, because the brokers and your companies will not set up a retirement system for you. So make sure and follow this rule. Pay yourself first. Probate and living trusts. Probate is a court-approved procedure to pay off the debts of a deceased person and to distribute his or her assets according to a will or intestate succession, meaning they died without a will. In real estate, you always want to avoid probate. That lengthens everything in the process. Minimum, what you want to do is have your buyer speak to escrow or a personal attorney, somebody give them advice on how to hold title to avoid probate. Some of the ways you can avoid probate is to take title as joint tenants in common, or community property. That way, if somebody passes away, the ownership is directed to the remaining people that you originally took title with. A living trust is a good vehicle too. With a living trust, the trustor transfers the property to their trust, but retains absolute control and serves as the trustee. Upon death, a successor trustee distributes the real estate without probate expenses. So please consider these. How do you take title? And consider a living trust.